So, the global economy is on the brink of a perpetual inflation crisis. Interest rates are too high, and many countries today they are starting to scream for rate cuts. And as you'll quickly see, the end game is going to be highly inflationary. Whether a recession comes in 2024 or not, central banks around the world they're going to cut interest rates, and it won't be from a position of strength, but from a position of weakness. This major economy's collapse tells us that global demand is cratering, and the only way to reverse this is through a ton of inflation. In our lead story today, Germany is one breath away from a recession. German industry shrinks for the sixth straight month in a row. Economists were predicting a gain of 0.3%, but the crash was a full percentage point away, which is a very big difference. Manufacturing demand globally just isn't there. Germany is likely already in recession since Q4 last year. Industrial production is a leading indicator of GDP strength, especially for an economy that is built on manufacturing. Germany's industrial production has been declining non-stop for half a year. Costs are up, demand for goods is collapsing, and more importantly, global interest rates are just too high. The higher interest rates go, the higher the cost of production. Companies are faced with either customers who are completely broke or they are scaling back their buying. And now Germany's wholesalers are starting to hurt really badly. Germany's wholesale sentiment has dropped to the 2020 lows. A negative sentiment here is bad because it tells us companies aren't growing, they aren't spending money on raw materials. When your customers aren't buying anything, there's no need to replace your inventory. No orders are coming in. There's nothing to replenish because your stuff is still sitting on the shelves. In real terms, the Association of Wholesalers and Exporters expects a 1% decline for this year, following a 4.25% contraction in 2023. This is a disaster because the numbers already account for inflation. In other words, businesses have contracted last year and will likely contract this year as well. So, what we are seeing is an economy highly sensitive to industrial demand starting to contract further. It's a perfect barometer that tells us the health of consumers all over the world. When interest rates are high, it destroys consumer demand while jacking up production costs. It's a double whammy for the economy. Let's not forget about inflation as well. It is still a big problem globally, especially in Germany. While wages have increased by 5.6% in nominal terms, after inflation, they've actually declined by 0.4%. That is in real terms. So people are working more, but their buying power is going down. This isn't just isolated in Germany. Many other industrialized economies are starting to drop like flies, like dominoes. If Germany falls, the EU as a whole is also doomed. And it gets worse. The second largest economy in Europe is also facing a real recession risk. From Bloomberg, UK's recession risk lingers on despite a rebound in November's GDP. It went up by 0.3%, but there's a big risk of December going negative. Apparently, it was raining again and strikes were happening. This could send December's GDP cratering, which could confirm the UK has entered a technical recession. There will be disaster for Sunak's election campaign, but that aside, it shows the effects of high interest rates. The Bank of England set rates at 5.25% today, and is causing massive economic stagnation. And that is the lag effect manifesting in the UK. So it's no surprise that many people want rates to come down, especially all the politicians in an election year. The only barrier to rate cuts is for inflation to come down fast enough. Forecasts are expecting inflation to drop down to 2% by April this year, and that will give the UK enough cover to drop interest rates rather aggressively. I want us to remember that these are the official CPI inflation numbers. They don't really reflect what's happening on the ground. Inflation around us in the real world is most definitely much higher. But if the official CPI comes down enough, central banks can cut rates to prevent or at least preempt an economic collapse. Now, it might not be enough to prevent a recession in the short term, but it's going to cause an inflation crisis down the road. At least in the UK, traders are pricing in 5 rate cuts in 2024. Remember that the cuts are coming from a position of weakness and not economic strength. The market expects cuts to happen because of either a recession or the Bank of England trying to front run the collapse. None of these scenarios are good, right? Prices of everything, especially assets, are going to hit higher in the next few years. The ECB confirms this, saying that rate cuts are coming once the actual inflation is heading back down to 2%. Officials see the first cut coming around June while the market believes it will be in April. But the consensus is that rate cuts are coming and it's going to be rather aggressive. Money markets are betting 6 rate cuts coming from the ECB, totaling almost 1.5%. This is even more aggressive than the Federal Reserve's own rate cut estimates. You only cut rates because the economy is weak. If the economy is so strong, you'll stay where you are. And for the ECB, that's at 4%. Obviously, the health of the economy is bad enough for them to take action. Interest rates have to come down even though there's a risk of inflation hitting back up. And if we look beyond Europe, the big boys around the world, they are also slowing down fast. And here's where we need to talk about China and Japan. The second biggest economy is slowing down and Japan's GDP has gone negative. These two countries, they are huge manufacturers and exporters to the world. A slowdown in economic growth is a direct result of the world importing less. There's a direct correlation between global demand and the health of these two economies. And let's talk about China first. They have the world's fastest growing middle class and Beijing is the world's factory. But we are seeing weakness on both these fronts. In 2023, we can see a drop in China's exports and imports. Both are declining because demand just isn't there. China's exports dropped for the first time since 2016 as demand cools. A slowing global economy and tensions with the West are weighing on trade. China manufactures and sells almost everything to the world, right? From all the cheap stuff to high value products. And this slump tells us that across the board, consumers are scaling back. Exports fell by 4.6% last year. Global consumption is cratering and is showing in the numbers. Imports from China have also fallen by 5.5%. Demand is going domestic. Chinese consumers are spending more internally and ditching exports, especially from Europe. So don't expect China to save the world. There's a property crisis going on and domestic consumers are scaling back. They're spending less and this is going to affect everyone around the world. Which brings us to Japan. And by all accounts, exports from Tokyo should be soaring. They are part of the G7, they are allies of the US. There should be no issue with the West trading with them. The yen is also down by at least 20% to the US dollar. So demand for Japanese goods should be off the charts. GDP should be exploding higher because the world can buy more from Japan with the same amount of money. But we are not seeing that at all. Not only is Q3 GDP down by 2.1%, exports from Japan have gone negative as well. Looking at Japan's exports to the world, it has contracted by 0.2% in November. Since September 2022, Japan has been exporting less, even though their currency has collapsed. And this is a symptom of global demand dropping because of higher interest rates. The flow of credit has been disrupted, and now spending has come crashing down. It's not rocket science here. There's a big worry that Japan might change gears, that they might jack interest rates up to save their currency, but the BOJ is trapped. Firstly, their debt makes it impossible to raise interest rates without an implosion. And secondly, their aim of higher wages isn't really working out. Japan's nominal wage growth has slowed. It has crashed from 1.5% in October down to 0.2%. Remember that this is before factoring in inflation. Their inflation rate is around 3%, so effectively Japanese consumers are down by at least 2.8%. And this in turn is causing Japan to import less and less from the world as well. Imports in November have crashed by almost 12%, worse than the rosy estimates of an 8.6% fall. The Japanese consumer can't afford to import stuff now because salaries aren't growing fast enough. Japan can't afford to hike rates now because it will just destroy companies as salary growth will collapse. Rates will have to stay low because the alternative is simply unthinkable. So Europe is down, Chinese demand has fallen, and Japan is in crisis mode. That's three of the biggest economies all tapping out. And here's where we need to talk about the US economy. America is also trapped. There's no way out but to cut interest rates. It's a confluence of disasters. This is an election year, so Joe Biden has to make Bidenomics work. And let me define Bidenomics for you. It's simply endless money printing to prop up the US economy. There's a reason why US Q3 GDP grew at an incredible 4.9%. Over the past 18 months, the US economy has been growing quarter after quarter non-stop. The bulk of this growth came from consumption, government, and investment, but where is all the money coming from? It's coming from deficit spending where there's an obvious correlation. Q3's GDP increase came in at $547 billion. That's how much the US economy expanded. Curiously enough, America's Q3 budget deficit increased by $620 billion as well. I don't know about you guys, but there's an obvious connection between government spending and the economy growing. And this brings us to a horrible realization. Joe Biden might have found a solution to endless economic growth. There's a good chance we might not have a US recession in 2024. Biden could continue borrowing money to keep government spending high. And won't this cause bond yields to explode? Won't this cause the national debt to spiral out of control even further? We're already at $34 trillion and growing. And you will be absolutely right, unless the Federal Reserve starts lowering interest rates on the short end. In other words, the Fed has to drop interest rates to allow the US Treasury to borrow cheap money even further. To keep the boat afloat, the US had to keep borrowing a ton of money literally forever, and they can't do it without dropping interest rates. According to the IMF, the US will be the biggest borrower in the world for years to come. Over the next 5 years, America's net borrowing will be on average 7% of GDP. That's more than any country in the G7. That's 10 times more than Germany's borrowing limits. The only way to make this happen without destroying the US bond market is to lower interest rates. 2023 has proven that fiscal policy is more important than monetary policy. And this means the Federal Reserve isn't as independent as they say they are. Their moves are meant to accommodate what Congress really wants. Just listen to Powell. The federal budget is on an unsustainable path, meaning the debt is growing substantially faster than the economy, which is in the long run, by definition, unsustainable. So if the path is unsustainable, how do you solve it? The only way to make things sustainable is to lower the cost of borrowing by slashing interest rates. And this should be terrifying. This will back up a bigger inflationary problem that will manifest much faster than before. And here's how bad the fiscal situation is going to get. In 2024, the G7 will be selling at least $2.1 trillion worth of new bonds to finance their spending plans. That's a 7% increase from last year. Obviously, this can't be done at the level of interest rates we have today. You make the debt situation simply unpayable. That's why there's a big focus on mainstream media about the falling inflation situation. The numbers, they are falling fast. And the faster inflation falls, the faster interest rates can be brought down. But with the level of borrowing that's going to happen, we'll be back in the inflation crisis down the road. Then you add in the need to fund Ukraine and the conflict in the Middle East, right? More money has to be borrowed from the West. There's going to be tens of billions of dollars, maybe even hundreds of billions more being borrowed into existence. So it's undeniable that a bigger inflation crisis is coming for the US. It took around 10 years for the current inflation crisis to build. After the '08 crash, the Fed took rates down to near zero for almost a decade. Then we had this insane spike to nearly 10% inflation later. However, something tells me that the next inflation cycle will be much sooner. So is a recession coming in 2024? Maybe not, but what's guaranteed is a bigger inflation crisis because fiscal spending is simply out of control. But let me know what you think in the comments below. How fast will central bank cut interest rates, and are we stuck in perpetual inflation? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these inflationary times.